Welcome to Rockstock Channel, Peter Hannah. It is September 28th. We've had a number of your colleagues on before, Will Adams, I think, and Martin Fasada, no longer there. But Fast Markets, Rodney and I spoke at, I guess, in Phoenix. You just had your Europe event. I met you. I've been reading your stuff for the past, year or so. I listened to your very good podcast with Joe Lowry a little while ago. To have this kind of conversation, and I'm glad we've had multiple conversations, and you've now put into the public domain a great three-part piece on spodumene pricing, which is going to be the main focus of this conversation. But I want to cover just some of your takeaways from the Fast Markets event, and also talk about this SGX. The Singapore began trading a carbonate price, index, I guess in competition with the LME and the CME's, hydroxide. So if you could talk about that, and a very quick introduction of yourself and what you do for Fast Markets, Peter.
Sure. So yeah, first of all, thanks a lot for inviting me on the podcast. I've been a long time listener and watcher of you guys, and learned a huge amount over the years. So just a brief introduction to me. So I've been at Fast Markets for around 9 years now, working on our price development across a number of different commodities. Started mainly in the bulks, things like iron ore and manganese ore and alumina and some of those. But over the past couple of years, had more of a direct focus on the battery materials like lithium and cobalt. I've got a background in geology, fair time ago, but for the last few years, it's been more focused on the markets and pricing mechanisms. So yeah, to answer your question about the Fast Markets Conference. So yeah, it was Barcelona last week. It was a nice week and a good chance to see everyone in the industry again. There's about 350 attendees, so a good crowd. I think some of the key takeaways were, well, for a start, it was quite Europe focused. So a lot of talk about Europe's security of supply, and in particular raw material supply. There seems to be a little bit of a difference in the rhetoric or the words that you hear from a lot of the European policymakers around this industry being very critical, but that's not quite matching up with the investment in especially the raw materials end, where there's issues of classifying potentially lithium hydroxide as a toxin, and also NIMBYism in a lot of the potential raw material development projects. So that's an issue that the industry there is kind of grappling with. Another one is, how this dynamic of inflation versus recession plays out. I think it's the new version of what we had a few years ago, where people were debating whether COVID was going to be more of an impact on the supply side of the industries or the demand side. Now it's, okay, we have inflation in the system. Is that going to continue pushing up prices of products, or is it going to start to really eat into demand? And I think the conclusion on that one is generally that yes, it may start to dent demand for products and including vehicles, but the ICE vehicles are likely to bear the brunt of that, as the wait lists on EVs these days are long enough, and the demand is still being powered primarily by those who are pretty affluent and can afford these EVs. So it's not expected to have a huge impact on EV demand. Obviously, if we're a few years further down the line where we're really kind of driving at mass market adoption, perhaps we would have had a bit more of an issue and be more of a concern at that time.
Okay, great. So Europe is kind of muddling through a bit. They seem to be ahead a few years ago, have kind of moved to the side. They're still there, they're relevant, but nothing definitively positive or overtly negative. But I heard some statements out of the European Commission and various people talking about the criticality and maybe setting some strategic projects across the continent. But Europe, there's a lot of countries, and I'd like to see the dollars allocated. I'd like to see the European Investment Bank invested in LG Chem facility in Poland. They invested in a Umicore facility of cathodes. I'd like to see them write a check, right? For something similar for lithium, among the projects that are there. And until that happens, it's all talk. Okay, so secondly, SGX, the Singapore exchange, just launched a carbonate contract a few years ago. There was all this talk about competition between price reporting agencies about the LME, hydroxide contract. that's been a bit of a damp squib, I think, overall in terms of trading volumes on the exchange, and the LME has had a bit of a black eye this year with what happened kind of like in nickel. So if you could comment, I guess, more broadly on what's happening with the evolution of price indexes for, risk management. They all seem to be focused on, the chemical side of things, but the bulk of this conversation is going to be about, how spodumene may emerge, in that. But just tell us about, the SGX launch, which seems to be a lot more liquid than the LME and CME contract, like right off the bat.
Yeah, sure. So yeah, SGX launched earlier this week, actually, 26th of September, with 4 new contracts, 2 for cobalt, but they launched both lithium hydroxide and lithium carbonate. But lithium carbonate, I guess, is the USP, as it's unique. The CME and LME both have listed lithium hydroxide. In all the cases, they all settle against the respective fast markets price indices, and I think the catalyst for these is the fact that you've now got a lot more industry exposure to those fast markets indices in the physical market. So as lithium pricing mechanisms have evolved and become more index linked, now there's a real direct need to manage that risk and hedge in price exposure. So the launch of the LME and CME hydroxide contracts, they were sort of, the planning for those started at least 3 years ago. And the thinking at the time in the industry was that, high nickel was going to dominate, and the hydroxide market share was going to continue to grow and overtake carbonate. So at that time, it was almost seen as an idea to get ahead of that trend by, going straight with hydroxide, rather than kind of launching both or risking splitting liquidity. But in hindsight, that now looks like a bit of a mistake, and it is. I mean, obviously, LFP's had a huge resurgence, and carbonate is still the more dominant salt, and it's also the more tradable product as well. Obviously, hydroxide's got the shelf life issue. Carbonate is slightly more forgiving in terms of its specifications. So the industry has been really calling out for a carbonate contract in order to just manage the price risk. And it's not a physically deliverable contract. So, none of these are like the LME base metals where you have a terminal market mechanism. They are just really a venue to manage price risk and just have a cash settled means of hedging or locking in prices.
That's obviously, I mean, based on my experience in the derivatives market, Peter, obviously that's hugely helpful that you don't have this massive rollover risk if you were to expect the physical. So in this instance, you can just square up and move on until volumes sort of find their way.
Exactly. And also, these lithium markets and even, many other battery materials are just not really all that suitable for that physically deliverable mechanism, just given the specification requirements, the fact that you need to qualify through different supply chains. The idea of letting a contract expire and going in with a warrant to a warehouse and picking out random bags of the product is just not something that's very appealing. Adding the ESG requirements and tracing your supply chain, it's more something
that doing the provenance of each and every delivery could be quite something.
Yeah, so people are looking for a price risk management tool rather than a product delivery mechanism or ecosystem. Okay,
that makes sense. But managing price risk is very important with ever rising prices here. And if you're an OEM trying to figure out how you're going to sell electric vehicles, and lithium starts accounting for a very large percentage as one ingredient, but there's no forward curve. We'll see how liquid and how that evolves.
Just one question, Peter, is on the settlement, just so listeners know, there is some kind of a standardized spec sheet that is the implied settlement on that contract.
That's correct, and it's a good question. So it's the fast markets CIF, China, Japan, and Korea index for both lithium carbonate and hydroxide, and we price to a spec. So it's a particular battery grade specification that we're pricing to. Obviously, in the real physical world, there can be different price realization around that, but it is a standardized price that the contract settles on. to go to Howard's point, yeah, I mean, it's early days of all of these derivative contracts, and the space will take some time to develop liquidity and grow. What gives me confidence is that this is no longer a small market or a small industry. So there's not many other markets of this kind of size and significance that don't have a mechanism to manage risk in the forward market.
We're going to move to spodumene, and to Elon Musk's point is that refining is the hard part and mining is the easy part. And again, he's gotten wrong where the margin is. So your three-part piece, which is an outgrowth of a number of conversations we've had, is broken down into how is spodumene priced, how should spodumene be priced, and why you should care about how spodumene is priced. It was great to hear. I'm looking at you. It looks like you have 1 year experience, not 9. But to hear in your background the aluminum and the iron ore, that actually was a very significant genesis of a line of questioning and interest of mine. So I did a fair bit of business in 2010, 11, 12 in the iron ore space when the iron ore market shifted from yearly negotiations where you had this mating season between Nippon Steel in Japan and POSCO in Korea with Rio Tinto and BHP. And at some point, I don't remember who moved first, Rio or BHP, they said, we want to move to kind of quarterly pricing. And I see Chris Ellison bringing this kind of mentality to the lithium dialogue. Most recently, is now famous, if you own your rock, you're God. And he wants to, price to the day and restructuring the joint venture with Albemarle. So I'm wondering if, and we talked about this in our Joe Lowry podcast, that if Albemarle if they have 100% of the marketing rights from Albemarle, but if 50% of their material is being priced on spot pricing, the price of the day, how could they commit themselves long term to those Wodgina tons that they're converting to hydroxide, on long-term contracts? I don't think they can. I think they will be forced, at least on those tons, to have it as variable as their input costs. So they're not going to want to take that price risk, unless there's a very liquid like if your hydroxide forwards are such that they can utilize that. So it might switch. It might force them. Albemarle may then have their BHP moment or Rio Tinto moment and say, okay, we're now switching hydroxide to full spot. I also asked Rodney and Joe, and both of them didn't agree. I just asked a question. I don't have an answer to the question, but maybe you have a different. I want to ask you the same question. Is that right now spodumene is priced linked to the chemical price? Now, with a lot of spodumene coming on market that's not integrated, like Sigma or North American Lithium's case. I mean, a lot of the companies who are producing spodumene do have downstream aspirations. Others do not. But can spodumene create its own market and price for itself? And could it ultimately be the driver, if not for carbonate prices, maybe for hydroxide prices?
Yeah, there's a lot of questions in there, but I think I'll take the last one, I guess, first. Can spodumene be priced on the basis of, on a standalone basis? I think yes, and almost my thinking around that has developed as I was writing through those articles. Based on what I've kind of thought about and considered, I think it can be when you look at how iron ore is priced and how other products like alumina are priced. In the case of iron ore, you've got an issue where the steel market is very difficult to commoditize. Steel is many different commodity markets, so you really need a strong upstream proxy. So iron ore is almost essential to be the global commodity there. But alumina, you've got Aluminium, that's a great commodity, but it's still detached. You still had an upstream feedstock that became a standalone pricing mechanism. And I think that you've got a good reason really for spodumene to do that here, because the bottleneck in this industry is at the upstream end currently. So what you want is a nice strong price signal to be sent by spodumene to really incentivize that upstream investment. So I think it can price on the basis of its own spodumene index. I don't think it would necessarily be the price that then drives everything else in the market. I think that there's a place for separate pricing for all three main products, so spodumene, carbonate, and hydroxide, and at varying points in time or under different market conditions, one may drive the other to a certain extent, or sort of lead the picture. To go back to what you identified there with the mineral resources and Albemarle picture, I think that is an interesting one, and is a good one to kind of identify. So, you know, a golden rule of pricing management is always, you know, keep your price exposure either fixed to fixed, so fixed on the upstream, fixed on the downstream, or floating to floating, so that you kind of have a natural hedge there. So what would happen if, yeah, mineral resources starts insisting on selling spodumene on a, you know, fixed price spot index price of the day, then yes, it would create more of an urgency to make sure that the downstream pricing was similarly reflective of its own price of the day there. Going back again to, you know, what you were talking about the development of the iron ore space, I think in iron ore there was a BHP moment, and it was driven by, you know, BHP's ideology around that market, especially as you got big swings in supply and demand as China grew. So yeah, it's an evolving space.
So Peter, you know, the first of your three articles was how is spodumene priced, and I guess I had a thought or a query on, if you've got companies that are fully funded, like say Liontown was with prepayment and equity raise, then they have the flexibility of choosing any mechanism that's out there, I guess, to maximize for shareholders. But could we see a situation in the future where we move to sort of jurisdictions and projects and flow sheets that possibly are a little bit of a stretch to get to fully funded, or are not going to get there, so that they might need something somewhat unconventional, or even a standard, you know, bank loan or a physical loan where they have to cap and floor? So do you think that could play a part in, you know, where future projects are going to come from and how spodumene is priced?
Yeah, I think it's a good observation, and I think the answer really is that often, you know, is not in the producers or the project developers' hands necessarily to decide how they price the product. Obviously, often it's the case that the one fronting the money is going to have the say on how it's priced and the mechanism. I think there should be enough new entrants or new producers who are able to take their own decision on product pricing, that I still think that the spodumene will increasingly have its own price of the day and be priced in that way. But also, I guess a relevant part of this is the development of those derivative contracts. So as you get more transparency in the forward markets and the ability to offload your risk, then, you know, those who are loaning money for financing projects will increasingly be able to manage their risk in the forward market through things like SGX or CME or LME derivatives, and, you know, have things like collar options in there.
In aluminum, right, you have this concept of green aluminum, right? You know, and Quebec is a major aluminum jurisdiction. Rio Tinto is all over there, and I think Alcoa is as well. But I remember going to LME week, 3 years ago, and there was a lot of talk about green aluminum there, and everyone was, the statement was that the auto companies, the other companies, they weren't willing to pay a premium, right? But I know a former Rio Tinto person who basically said they are getting a premium. It's just not like so transparently priced, right? So in the long-term negotiation. So what, from a sustainability point of view, do you think that there'll be green premium, for lithium? One question. Then there's like a security of supply. Like it's so much more costly to build. The capital intensities outside of China are so much more in every jurisdiction. But in order to have that kind of justifies that you should be paying a higher, price for that. Related to that is like natural gas is, that is a commodity, but it's priced very differently based on logistics of, geography. So do you see, like let's say a North America and European price disconnect to, let's say, these benchmarks, pricing that you're having from China on the SGX platform for ESG and security of supply, reasons?
Eventually, yes, I do. I think that there'll be regionalized price differentiation and price differentiation based on the ESG factors as well. A lot of that, I think, is going to be policy driven. So if you look at the IRA regulation now, if your supply can be IRA compliant, then presumably you're going to attract a premium for that. And likewise, from an ESG standpoint, if there's anything similar in a similar vein to the European carbon border adjustment mechanism, then you're going to have a price differentiation based on things like carbon intensities. What that looks like is a bit too early to tell. So it could still be that the North Asia nexus is so big in terms of demand that still represents the clearing price, and that you have sort of regional premiums or differentiation to that. Or you could have entirely standalone prices for, say, delivered North America or delivered Europe. But yeah,
do you think do you think that there's a risk that Europe's got the policy right, but not the carrot? They've got the stick right, but not the carrot, in the sense that you're going to end up having quite a hefty premium to try and secure the right material in Europe, but not the available supply domestically or elsewhere, so that OEMs are ending up in a prejudiced position.
100%. Yeah, I completely agree with that. And I think until they get more of a carrot to build out their raw material production, then they're going to be in that sort of quandary.
When these markets develop indexes, they're illiquid, but as they're developing, it's not just physical actors in there, but speculators kind of come in, financial market participants. As much as you want to create price transparency and hedge risk, the speculators often in illiquid markets make the price even more volatile. So do you see a risk of that in the carbonate and hydroxide contracts, and if something develops as well in spodumene?
I think that's always a bit of an academic debate, whether speculation in markets adds to volatility or not, and whether futures contracts, futures markets create more volatility than they subdue. I tend to come down on the basis of price transparency is a good thing for market forces, bringing supply and demand into line and where they need to be over time. So I think that speculators are an important facilitator of liquidity. So they essentially, they help to make the market, and ultimately the physical supply and demand will be the ultimate arbitrator of where price ends up. So no, I tend to come down on the other side of that and think that liquidity and transparency in the forward market are a good thing for the industry in terms of guiding where the investment needs to be made. And my hope is that over time we don't see prices bounce around from $10 a kilo to $80 a kilo and back again, that we sort of find more of a reasonable price band where supply and demand match up a little bit better.
Okay, going back to spodumene, I mean, you have the Pilbara's BMX platform. They're only putting up a small, tonnage there, but it is a real-time price. Are you, as Fastmarkets or others, working on a spodumene, product? I mean, there's a lot of tons. If I look at our Mr. Market scoreboard, a lot like the hard rocks in terms of market caps have, increased. The percentage of, the companies that are there. And Rodney has been saying this for years. And we think like the fastest market to bring lithium tons along are spodumene tons, especially if they're dense media separation only. So you have, Sigma has a bunch of uncontracted tons. They're fully financed. And also just going back to the Tesla point, refining versus mining. To build a refinery, if you look at the Kemerton and Kwinana, these are very complex. They take a long time. There's big cost overruns, billion-dollar projects, whereas, Atlantic just came out with a PFS for $125 million, right? And 225% IRRs. These are 200% plus IRRs versus, an integrated, chemical conversion plant that may have, 30, 40%, IRRs after much more complex, kind of CapEx. So there should be a rush. Pilbara shows, Altura, shows you can bring spodumene tons to market, and people are discovering them. There's a lot of drilling activity, and if you could follow that, in a 4-year, kind of time frame, bring something to production, you could have like a Goldman Sachs, a Morgan Stanley, a Deutsche, a Credit Suisse, or whatever, creating a financial product based on a much lower risk endeavor, bringing hard rock spodumene, provide some capital, but also take some of the logistics risk there. S&P Platts created this 62%, over-the-counter contract. It wasn't an exchange. That became the benchmark that was used by these trading desks. So I'm just wondering if those things are in the works, because I know some banks want to play here in the spodumene market.
Yeah, so to your first question, we do have an existing spodumene spot price index. It's a SC6 basis, CIF China index. It takes on things like the liquidity that come from the BMX platform. Fastmarkets is always big proponents of industry platforms that add transparency to market and create that transparent venue where you get proper price discovery. We're fans of the price discovery that comes from the BMX platform. Unfortunately, obviously, is limited, and we'd like to see that improve in the future. I think if it does, and I think it will, as more tons come to market, whether it's that platform or just people doing their own spot tenders, as we see more spodumene supply come online, there should be more price transparency, and that should increase confidence in spodumene as its own price index. And yeah, you could see it develop as a standalone product that then requires its own derivative. But even in the nearer term, I mean, you've got part of that infrastructure now that you discussed in place. So the way these derivative and futures gain that liquidity is always initially through banks or financiers doing OTC deals, and then going to the exchange to offload that risk with an opposing position. And you have the ability for that now in lithium carbonate and lithium hydroxide. And it's probably not a huge stretch to say, well, that will correlate enough with spodumene to start doing that, even with the structures that we have. Although obviously, down the line, it would be a lower basis risk and a cleaner hedge if you had a spodumene product as well. And just to mention as well, so obviously on SGX, you had the Platts 62 index. Around about 3 or 4 years ago, they launched a 65% FE index as well, which is Fastmarkets settled. So there's always scope for development of new products, new grades, new types of instruments as these markets evolve. So I think we could see spodumene have its own ecosystem down the line as well.
Sprott just announced they're in market. I just received a red herring prospectus about a unit trust, a product that's going to store lithium carbonate as well as nickel and cobalt. So they're raising money so that they could buy the physical for investors who want to speculate on the price of those 3 commodities. So what do you think about that from a lithium carbonate perspective? They're going to be out there. Sprott will be a buyer holding lithium carbonate, on the expectation that I guess the price is going up, or they'll play it somehow. So just any comments on that new development?
Yeah, I think it's a nice development to see. I think obviously it's a tight market to be going in and buying product in at this stage. So from an industry perspective, I think it's not exactly like this market needs tons to be soaked up by any means. But in terms of the what it gives investors, the ability to access exposure to the underlying commodities, that's something that you can't really do at this stage. With the development of the cash settled derivative products, then that gives another angle and will give another angle down the line. But I think also perhaps the Sprott move is a catalyst that again might help develop liquidity on those exchange-based futures markets. If people are looking to play any sort of arbitrage between that physical holding and the physical market indices, then that's something that obviously you could do in theory on those derivative contracts.
So Peter, your third article is on why people should care, and you've actually raised an interesting point. I guess we've had the discussion earlier about where the margin sits and how that may evolve. The one thing I'm pretty sure listeners would want to hear is some more color on midstream potential products. I think that can change the environment as to what would be preferential. There's ESG considerations, waste, and I guess pricing. Is there any differential in process flow sheet to taking a midstream versus the spodumene? How that might evolve? How capital intensive is midstream? And if the world is really going to have carbon border tax or issues with ESG, is it something that might be forced to become a standard of some sort?
Yeah, that's a really good question. I'm not actually too familiar with things like the capital intensity of those processes and the flow sheets, but I think it is an important qualification to the notion that spodumene is going to be, a huge relevant commodity market into the long future, because it certainly seems just on the face of it that those midstream products that inherently contain more lithium units at the compound level are better carriers for lithium, and that's ultimately all that spodumene is. I mean, other than some high-end technical applications, you need spodumene because you want to convert it into a chemical. So whether that changes the picture, and further down the line we actually see markets for things like lithium sulfate or lithium phosphate, I think that's an important qualifier and caveat to the idea that spodumene is going to be the big market. One of the conclusions I drew from the third piece was, if it were me, I'd look to maximize revenue in the near term, but have a sort of pretty decent plan to move downstream into the future.
Yeah, and you see, that to me is smart, because I think you can get away with just selling spodumene for now, but are you going to, even if it's not economically the most optimal thing, could you, from other forces by government or ESG or whatever, be forced into a midstream situation where you're penalized if you keep sending spodumene?
Yeah,
that's that's potentially a risk. Europe is definitely a candidate for stopping raw spodumene as one of the first. They won't want the waste coming their way.
Yeah.
Well, you have AMG, who is making a technical grade carbonate in Brazil and then converting that in Germany. So Peter, Chris Ellison basically said lithium's in deficit, until at least 2030. And he's saying, if you own the rock, you're God. He, at this point, he's played this very well. He saw in 2010, and he has the best partners in Ganfeng and Albemarle, and he had a gigantic resource in Wodgina. I mean, arguably, he's going to do it again with his investment in Global Lithium. We'll see about that, and he may make some acquisitions. But if you take his point that owning your own rock is key, and we're good until 2030, it's very hard to mine rock and go downstream. I mean, Piedmont has that strategy. That's their fundamental strategy. Livent has that strategy with Nemaska. But if you're developing, if you're Atlantic, if you're Sigma, like what's the motivation to go downstream for the next 10 years?
Yeah, so I think there's definitely an opportunity and a big window now that the tightness is on the upstream end to try and maximize that, and that comes back to establishing a spodumene pricing mechanism that allows you to get the price of the day. Obviously, margin now is better than margin in the future from a discounted cash flow perspective. So there's a real case to try and knock it out of the park now in the near term, but then at the same time have a plan to try and insulate yourself from potential cycles going forward. And probably the best way of doing that is to go downstream, where you increase your value add, and you hopefully sort of attract the higher multiples that the chemicals companies trade at. So whether your downstream move is in the midstream into those midstream salts or all the way downstream, it's probably something worth thinking about. But obviously there's different strategies to play it. Your goal could be, simply to look to be acquired as a spodumene producer if you can do well enough over the next few years. Obviously there's a lot of M&A and consolidation to be done in this space over the next few years, I'd imagine.
It's like any industry that grows very fast. It becomes fragmented for a time, and then it consolidates, and the major players will maintain, their moats, right, if they execute well and and integrate those assets. So we joked with Joe Lowry like about Albemarle paying over the odds, what seemed to be over the odds for Wodgina a couple of years ago, and they'll be proven right because the markets have, if you have a long enough time horizon and vision, and as we are mostly focused on exploration and development plays, you want to see that. You want to see the big players consolidate and take you out at the very high valuations, and where we see it, we see it risk reward wise, it's the easiest in hard rock, right? DLE and clay and other things, we're proponents for those as well, but it's more complicated, right? The spodumene to lithium units in a short time frame with not a lot of capital is where the bottleneck is, and you're seeing a lot of exploration, and development, on that score. But I was just questioning, like, why I asked Pilbara this question: why go downstream? Why do calyx? That long term, they just, because there's 94% waste, right? That's the key differentiating factor versus, let's say, iron ore. You don't want to be shipping around, a lot of that waste. And to Rodney's point, it may not even be acceptable to receive that in a place like Europe. But in terms of the multiple question that you have, we're going to talk to some hedge funds and other financial practitioners. You're focused on the, as a price reporting agent. This does matter. You mentioned Albemarle has a specialty chemical kind of mentality, but the disparity of valuations relative to sales, relative to EBITDA, of an Albemarle versus a traditional commodity player in iron or Rio Tinto or Alcoa in aluminum or copper and Freeport and U.S. Steel. I may put those up here. Just there is a dichotomy. Yeah. I think that could be explained by the growth of lithium, but I also think that all of those companies that I mentioned are deeply undervalued, deeply underappreciated, and there's scope. Like I own a number of those, ETFs. I'm focused on lithium, so I could pick individual stocks, but some of these other names as proxies for those commodities, I just think are greatly underappreciated. And some of it has to do with the fact that China killed the market, or there was a volatility of earnings, or they're perceived to grow less, or from an ESG point of view, that they're viewed as less investable, less sustainable, which I think is untrue. Yes, steel companies are not mining companies, but steel companies trade at, U.S. Steel is making tons of money and trades at 1 or 2 times, EBITDA. That doesn't make sense to me, right? There's a fundamental underappreciation for how critically important, high quality companies, and U.S. Steel is making green steel. Most of it is a lot of it's from recycled. So anyway, that's just an education in the market. There are cycles to mentality, and we put out this Refining Billions, podcast where we're quoting Robert Friedland and Jim Litinsky and Chamath Palihapitiya and Chris Ellison. There needs to be a shift in sentiment, and the fact that our channel still, has a relatively small following, shows that there's a lot of scope, right, to come here. When the shoeshine boy is telling you, you need to, he gives you a stock tip about a lithium development company, or Rio Tinto is buying Albemarle at 100 billion or 150 billion, then that's the top of the market. I think we're a few years away from that. But anyway, Peter, thank you very much for chatting with us today and previously, and your notes are great. Keep up. I agree with Joe that your boss Raju, should give you a raise for the high quality work that you're putting out, and look forward to having you on, again sometime in the future.
No, thanks very much, Howard, and thanks, Rodney. It's been really enjoyable. And as I said, I love the stuff and the content that you put out. So yeah, happy to chat anytime.